All right, good evening, guys. Ken at Tortoise Capital. This is the nightly strategy podcast for December 3rd, 2021, Friday nights. We're going to get to the weekend reports here. So we got a good full lineup for this weekend's research weekend. The folks are coming to make their presentations on a variety of short-term and long-term systems. We've got a couple pro money managers going to come in and show their stuff. Bill Scheit is going to do a very interesting one on a swing system simply using the PSAR flip. It is very impressive and it's working nicely with the crypto. Eric Morrison is going to show what the Forex group is doing. Worth is going to talk about automating. Ken Hum and Luke Crockford are going to talk about lessons learned from their craft of trading. Griff Cooper and Phil Wu are going to talk about what it was like to be an intern going through all of the foundations lessons and producing the note sheets and documenting the material and creating a nice little workbook for us. While they were doing that, they also learned a ton. So they're going to share what that experience was like. Tom Hardison's going to talk about team building and collaborating and building high performance teams. Lisa is going to present some material on a system she developed at the THARP systems workshop on trading sideways volatile markets. She was not a believer in them, but after the system, she is a believer, and it looks unsurprisingly a lot like the bar by bar material. So we got quite a nice lineup of papers to review. Plus, I've put about probably 20 hours of material into the backup references that I'm gonna hit the highlights of tomorrow or Sunday, and then that course is going to remain open in perpetuity for the folks that signed in, and so they're going to have plenty of time to review that. Plus, I'm going to be building that out as an archive with an archive section from the last 10 years, the research weekend, so that we have one-stop shop for all the work that we've done over the last decade. So I'm pretty excited about that. Just got to get on with it. Let's see. Let's go to today's. So today was kind of a nothing day. I mean, all of the gains from yesterday, which were, yesterday was a big response up from the great big sell-off of Wednesday. Thursday was a big move up, but today all of that was given back with a big gap down, and then it only came up halfway up the stack. So this was not a vote of confidence today going into the weekend, and we remain in tactically oriented timeframes here. So although the 3-period whole moving average is up, we've got the RL30 extension is down. The PSAR has flipped and is pointing down strong. So until we get through that, those two barriers, this is a market that has to prove that it's healthy. It is not healthy by any means whatsoever. And we've been flirting with this 10-day low at 450 for 3 days now. It tipped in there slightly, but didn't collapse further. But we're hovering on the Z-2 line, and today was not a very favorable vote to the upside. So this is a churning market, a volatile market, and troublesome. This is favoring the short-term tactical trades, and it's paying us to just be patient, to wait for the swing trades until the market settles in and finds finds new direction. Right now, it's pretty much churning and chaotic. All right, let's look at the sectors today. All right, so the S&P was down 0.87 today. Yeah, it's down 0.87. Diamonds were slightly better at down only 0.11. Treasuries were very strong, up 1.2% to close at 154. So that's looking pretty good. Emerging markets were off 1.4. Tech got smacked in the mouth at minus 1.74. And the Russell was down 2 full percentage points. Let's take a look at the underperformers today, starting with the sectors. Cut, one of the lumbers, was down 0.88. Then we have a cluster of oil exploration, finance, tech, 1.67. Commercial real estate, consumer discretionary, 1.94. Lithium, the FANGs, biotech, 4.4. And we're not even all the way down the stack yet. This is horrible. ARC got smashed, down 5 and 5.5. Moonshots, clean energy, blockchain, 6%. Bitcoin, 6.6. The Bitcoin Trust, large cap blended crypto, Ethereum down 9%. Then individual targets that suffered today. Robinhood, 11%, Coinbase, 6.7, Tesla, 6.5, still above 1,000, but testing a crucially important technical level. Squarespace, 5.5, Virgin Galactic, 4.7, Microsoft down 2%, PayPal and Alcoa down 1.5 to 1.7. So everything getting slaughtered today. Even Apple was down 1.17. Only a few things were better than the market today in terms of the sectors. We have energy was only down 0.87. The other lumber, 0.6. Oil, wheat, and precious metals, 0.6. Mexico and materials, 0.3 and 0.2, respectively. Blended commodities in the green, 0.1. Marijuana, 0.11. Brazil, 0.17. Agriculture, 0.4. And then consumer staples, really the only S&P sector that was any good today, 1.24. And then the VIX was up 8.5%. Individual companies that outperformed had a nice bounce, tradable move in U.S. Steel, TX, the steel company, Devon Energy, Cliff Natural Resources. And then John Deere. Not much to choose from on the upside. This was a very gloomy, ugly, not good, bad day going into the weekend. The employment report was just horrible. And Washington's not doing much, but the only thing they did do was sign another continuing resolution. But feels like we are rudderless. All right, let's. There was only one chart posted today. This is from Bill Scheit. Now he's going to be briefing this system that looks really, really good as a swing trade system using the PSAR flip. And let me get that. You can see this one's not optimized. All right, so this one is in S storage AUSD. Little currency action here. So his first one was about a 0.5 loss on the gap up, and sold off halfway and then crushed. Then the re-entry occurred on a COTA 2 and the PSAR flip, so he just buys it like he's supposed to. Now, this is the one where I'm trying to coach him that when you get something after that goes beyond Z3 and gets all the way up to here, don't let that come all the way back to the PSAR dot, even though it's 2.15. Because if you look at that, if you look at the gain, we left 2/3 of it come back. So there needs to be a modifier on his system. So what he's executing though is by the rules, by the numbers, and that's a 2.5 or 2.15 win. But I also think that there's room with just a little bit of adjustment that when it gets past Z3, that would also have preserved this move instead of letting it come back to fail. When you get beyond Z3 and it starts coming back, you need to, like I think I would have advised him to execute here instead of here. But we'll see some more briefings on that tomorrow and take a look at the very impressive numbers for performance. And we'll talk some more about that tomorrow during Bill's presentation. All right, there were no other charts posted, so we're going to go right to the weekend reports. All right, so we are still in bullish volatile conditions. Overbought on the long term, high neutral on the 90, still troublesome on the 10 and the 30, had just a little bit of recovery today. Still in trouble here on red bullish, and the risk Z has given us that warning of abnormal adverse volatility. ETF2 is down to 20% exposed. You can see the positions that are being held. This looks like a reasonable posture to me. You'll be happy that if you're in treasuries right now. On the monthly, second month we're in the second month of the drawdown. That the last time that it went deeper than this. That was the one for COVID right there. The 9-day is clearly rolling over, and our stop up here around 460 is still looking pretty good. Weekly is definitely showing the weakness. Remember, that can last 4 or 5 weeks before it reverses. Last time it got all the way to the Bollinger Band mean. This time, if it gets to the Bollinger Band mean, it's got to get to 440. And again, that 460 is looking pretty good. The 3-day also showing some troubles. Remember, that lasted almost 25 days. We've seen the daily. Looking at the blended monthly rebalancing, you're seeing quite a few now are below their 4-month moving average. So we're seeing weakness across the board. Treasuries and tech are where the juice is. Don't be deceived by the Latin America. That's a 1 week anomaly so far. You can see utilities, the defensive sectors in play there. This is a case where I prefer the treasuries because they have that, even though they are slightly lagging compared to the blended percentages, the short-term defensive qualities of treasuries are very clear right now. In the ETF 32s, again, treasuries are holding up pretty well. Technology is not bad compared to some of the other choices, but you can just see how volatile that oil sector is. Much better to be played as a weekly swing than a monthly buy and hold. Apple's in a bit of a recovery right now. United Health is about the only other thing competing with it. We're down to just 2 of the 10 big indexes on buy signals based on price better than the 4-month moving average. That's tech and the S&P. Otherwise, everything's on cash. That's why we're at 20% and 80%. 20% of us, 80% cash and ETF2. Tech is showing some strength, as are the large caps in general in the U.S. Otherwise, it's pretty slim pickings around the world of equities right now. Home construction not doing too bad. Again, home builders and the treasuries starting to look strong. We use the ATR percentage to identify those great short-term traders. So you got oil exploration and regional banks, S&P biotech, very liquid, very volatile. Brazil, perennial favorite. Semiconductor holders, and the energy sector itself. All right, let's look for the dailies. Those numbers are not quite right, but it's we've got lots of things well oversold. I'll get that updated by tomorrow. Yeah, that daily got caught in the middle of a recalculation. I'll get those republished for us. The auto framer suffering, that market has that big pullback has set up a lot of goodness in the auto framer, and the size of the volatile moves has precluded the squeezes from happening. So that's everything I got for now. I'm going to rerun the daily report and get that posted. I had to get that published as is to meet tonight's time schedule, but let's see. Ken H asked me in TLT how far back do I go to look for resistance levels? Really just 270 days. After that, the market, that's such ancient history that I don't look much more than that. What you could do is take a look at the weekly charts, though. Take a look at the RL 270 on weeklies, and that's probably worthwhile. We'll take a look at that tomorrow. All right, guys, that's everything I got for you. I'll get this published and posted, and see you guys tomorrow.